Welcome to the third session of fundamental and technical analysis. So during the first two sessions, we discussed about the income statement and the balance sheet. And if there's any investor who is joining new for the first time, we recommend you that you go and watch the first two sessions, which is available on our YouTube channel, SA Securities Private Limited. So you can get the very basics. So during today's session, what we are going to look at, we are going to look at a few of the profitability ratios and the final key financial statement. So thus far we have discussed about the income statement, the balance sheet or the statement of financial position, and finally we will be looking at the cash flow statement. So just a quick recap of our program and what we discussed. So this is an introduction to fundamental and technical analysis. We will be keeping our technical jargon minimal and using a very basic language so that many can understand. And we'll be discussing about the very basic levels. So the main focus is not to teach you all how to prepare financial statements, but basically to understand and interpret them. Okay. So as usual, my name is Charitha. I'm the head of research for SA Securities, and I'll be taking you through the fundamental analysis part. And the second session would be taken up by Mr. Saliya, who would be discussing about the technical analysis. A quick recap of what we did in the previous sessions. We discussed about the income statement, where we compared our incomes and expenses in order to calculate our profits. And we said that you should look at companies where there is profit growth. And we also discussed about how to analyze the income statement, how to do horizontal analysis, and how to do vertical analysis. And we also discussed about few of the basic ratios that we calculate using the income statement. Those are the profit margins, the earnings per share, which is very important, where you divide your net profits attributable to equity shareholders by the number of shares, and the price earnings ratio. So I'm not going to go into detail today. If someone have missed, please refer to our previous videos on this topic. And we discussed about the statement of financial position in our second session, where you summarize your assets and liabilities, where you show what are your assets and how they are being funded. There again, we discuss about analyzing the balance sheet, and we discuss about the importance of equity. So equity is basically the difference between your total assets and your total liabilities, or you call it the net assets of a company. This is the theoretical book value of a company. So before investing, you need to see what is the true value of this company and how much is attributable to a share, where you calculate the net assets value per share. So that's what we discuss under ratios. And we also discuss price to book value, which is similar in principle when compared with when compared with price earnings ratio. So you can always refer back to our previous videos to get more idea. Now today we are going to focus on few of the profitability ratios. Mainly I will be targeting on the main two profitability ratios. The first one is return on equity. Now you all know what is equity. Equity is, in other words, another name is net assets value, the difference between the total assets and total liabilities, or you call it the shareholders' funds. How much of funds are being invested in a company by its shareholders is what you call as equity. So this could include the share capital. This could include profits which are being retained in the business without being distributed to shareholders. We call them retained earnings. So it's not only the initial share capital, but also the subsequent profits that have been earned by a company, but not yet been distributed to its shareholders by way of dividends. So that also belongs to the shareholders. So return on equity is basically you look at how efficient the company is turning in shareholders' funds into profits. Right now, shareholders' funds is like an investment. The investment the shareholders have made in a particular company, right? So equity is the investment in the business. You calculate how much of a return have you generated on this investment. So this is actually a return on investment calculation. Now, if you invest in a fixed deposit account in a bank, The return on investment is the interest rate that the bank will pay you on your fixed deposit account. For example, we'll say the bank is paying you 5% interest and you are investing 100,000 rupees. So you get 5% on 100,000 as your return on investment. So similarly, return on equity is a kind of a return on investment. It's a profitability ratios. How much of a return has the management of this company generated on top of the investment the shareholders have made, right? So I have underlined two important words. It measures how efficient the company is turning shareholders' funds, in other words, equity, into profits, right? What is the return the company have generated for the shareholders' funds that are being invested in the business? Because shareholders are the owners of the company. It is their money that is being invested in the company. So the profit that is being generated is the return that is being generated to the shareholders for their investment, right? So return on equity is an important profitability ratio. So there again, you need not calculate this. This will be given to you. You only need to be able to interpret this. So if a company can generate a higher return on equity, something higher than that you can generate on your own, you can consider that as a very profitable investment. Now, if you have your own investment, which can generate you a return on investment of, we'll say 30%, right? And if a company can generate a return on equity of, we'll say 50 to 60%, right? These are abnormal figures I'm taking purposely. Then it's worthwhile you looking at that, investing in that company, because you can generate only 30%, whereas the company can generate you 50%. Okay. So I will share with you the formula how to calculate this. Return on equity is calculated as a percentage. How you do it is you divide the profit attributable to equity holders. Now, in the previous sessions, we discussed about the statement of income, the income statement. There, we saw at the bottom, there's a line called profit attributable to equity holders. This is the profit that can be attributed to the equity shareholders of the company. So this is actually the return the company has generated for its shareholders. So that you divide by the average total equity or average shareholders funds. Now, why did I say average? Because during a year, the equity can change. There can be capital infusions. That means shareholders would have introduced more capital into the business by way of a rights issue, right? We will be discussing about rights issues in one of our future sessions. So the equity figure can change. So what you do is you take the equity value at the beginning of the period, you take the equity value at the end of the period, and you calculate a simple average, right? That is your average total equity. So you divide your profit attributable to the equity shareholders or the return the company have generated for the shareholders by the amount of the investment that the shareholders have made in the business, right? And that is one of the key profitability ratios that one should look at. So you need to compare it with the industry peers as well as maybe certain other investment opportunities out there, right? Higher the ROE, better it is. Okay. Then the second profitability ratio is return on assets. This is again an efficiency ratio, right? Earlier we looked at how much return have they generated on the investment of equity. In return of assets, what we do is we look at how efficient the company is generating earnings from their assets. Now, assets can include land and property, plant and machinery, right? Various other investments, all are assets. So out of the assets, how much of a profit have you generated as a percentage of your assets? For example, we'll say a company has 1 billion worth of assets. And the management have been able to generate a profit of 100 million during a 1 year's time period. So they have generated 100 million using 1 billion worth of assets. So you can simply calculate return on assets as net profit divided by average total assets. So here again, why you take the average? simply because the assets value will also change during a year. So what you do is you calculate a simple average where you take the assets at the beginning of the period and assets at the end of the period, add them together and divide by 2, right? So this tells, compared to the investment that has gone into assets of this company, what is the return that have been generated, right? Return on assets. Earlier one was return on equity, right? So equity is the investment the shareholders have made in the business, right? Second one is return on assets. So you take the net profit, not profit attributable to equity shareholders. You take the whole thing, net profit as a percentage of the total assets that are being utilized in the business, return on assets. So these are two profitability ratios which are important for you to interpret. So what you can do is, there again, you can compare with the industry peers and you can see whether these ratios have improved over a period of time, right? Is it an increasing trend or a reducing trend? There again, higher the ratio, it is better. Okay, so we have discussed quite a number of ratios on the income statement, balance sheet, and today we discuss about profitability ratios. There are various other profitability ratios and where there are various other efficiency ratios, but I don't recommend you looking at everything at the introduction level. As we move on, we'll discuss about that. Okay, now we are moving on to the third financial statement, the cash flow statement. Now, before discussing about the cash flow statement, I'll give you a simple scenario. Now, the income statement is prepared, or the main focus of the income statement is to compare your incomes with your expenses and calculate the profit. In simple words, you deduct your expenses from your income to see whether you have generated a profit or loss. When preparing the income statement, it is prepared on the accruals concept, right? So if you don't know this concept, doesn't matter. I'll just give a simple introduction to it. Accruals concept tells you, you have to prepare it based on the income earned and expenses incurred. Income earned means you have earned it. You might have not yet received it, right? Income expenses incurred means you have incurred, you have a liability to pay for it, but sometimes you might still have not paid for it. So when calculating the income statement, you don't see whether you have received or paid, you have to see whether you have earned or incurred. Let's take a simple example. A company might sell on credit. So the credit sales in the month of December is recorded as a sales income. But however, cash will be received in the following month, which is in the month of January, which is falling into the next financial year, right? So you have sold during the current financial year and recorded it as sales income. But however, you have not received cash for it. So in the income statement, you have shown it as an income when calculating the profit, but actually you have still not received cash for it. Similarly, there can be expenses. You have purchased on credit during the last month of the financial year. So when you purchase, you show it as an expense during the period. But however, you have still not paid for it because you have got 1 month credit facility. So you will be paying only during the month of January, which falls into the next financial year. So in the income statement, you have deducted this credit purchase as an expense, though you still have not paid for it. So there's no physical cash outflow, right? So what you calculate as profit in the income statement does not necessarily mean that you have generated that amount of cash, right? The profit figure, what you arrive in the income statement, does not mean that you have generated the same amount of cash, because you consider incomes earned, not yet received, as well as you consider expenses incurred but not yet paid for, right? So if someone did not really understood what I said, don't really worry about it. Just get this idea where the income statement, the profit is not always cash, right? You might have earned more cash or less cash. Okay. Therefore, we need to prepare a statement called the cash flow statement. The cash flow statement will simply look at the amount of cash that had come into the business and the amount of cash that have left the business, and will tell you how much of cash you have generated during the period, right? So the cash flow statement summarizes the amount of cash and cash equivalents entering and leaving a company. So what are the ways you can cash come into a business? When you sell on cash, you get cash. If you apply for a bank loan, you get cash. If you receive dividends, you get cash, right? Those are cash inflows. What are the ways that cash can leave out? When you settle your purchases, you have to pay cash. For your certain other administrative expenses, salaries and wages, you have to pay cash. So cash will leave the business. So the cash flow statement will look at the cash receipts and the cash payments, which is totally different to the income statement principle. Income statement looked at the accruals concept, right? You record them if they are earned or incurred, not when received or paid. Cash flow statement looks whether they are received or paid. Okay. So the cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. Now, a company can incur a loss, but it can continue to the future. While incurring losses, a company can continue to the future if that company is generating sufficient cash to settle its liabilities, right? The moment a company run out of cash to settle its liabilities, that company will be in trouble, right? You say that the company needs liquidity. Liquidity is the ability to settle your obligations, your payments in the medium to short term and long term, right? So liquidity is more important than profitability. A company can continue for a few years even while incurring losses as long as they have liquidity. Liquidity is the ability to pay out your liabilities, your expenses, right? Just imagine if you don't have cash to buy your raw materials, how can you do your production? So when you can't do production, you can't do sales. If you don't have cash to pay salaries and wages, people will not work for you. Then you can't run your business. So liquidity is very important. So the cash flow statement really looks at how well they're generating cash and do they have the ability to settle their debt obligations and other operating expenses. So it is always better to invest in companies that are generating a net increase in cash, as liquidity is vital for survival of the business. Okay, so what I did here is basically introduce the third financial statement, cash flow statement, and explain to you why the income statement alone is not sufficient, because the income statement will tell only the profit. Profit is not always cash, because there are so many non-cash items included in the income statement, right? Okay, so now what are the main three areas in a cash flow statement? There are three main areas. The first area is cash flow from operating activities. Now I'm trying to keep it simple as possible because you all are not here to learn how to prepare a cash flow statement, just to understand and interpret. So the first area is cash flow from operating activities. So what does it tell you? It shows the net cash generated from regular business activities, right? From your regular business activities, how much of cash have you generated? If you are in the business of manufacturing, we'll say tiles, right? How much of cash have you generated? If you are in the business of manufacturing garments, how much of cash have you generated through that business? Because that is not the only way you can generate cash. So here under cash flow from operating activities, what you do is you look at your basic or your core business operation. So typically this area you will start with your net income in the income statement, and you will adjust for working capital changes, interest expenses, tax expenses, there will be certain adjustments when arriving at the cash flow from operating activities, right? Okay. Then the second way you can generate cash is cash flow from investing activities, right? The first way is through your regular business activities. How much cash have you generated? Second way you can generate cash is cash flow from investing activities. What does that mean? It shows the net cash generated or spent relating to investment activities. Now, what would come under investing activities? Investing activities include purchase of physical assets, investment in securities, or the sale of securities or assets. Now, if you invest in plant and machinery, that's an investing activity. So when you invest in new plant and machinery, you will have to spend cash. So it will be recorded as a cash outflow. Now, do you record that in the income statement as an expense? No. If you invest in new plant and machinery, you don't recognize that as an expense in the income statement, right? Therefore, you did not reduce your profit. But however, your cash balance have come down. So that is why we are adjusting it in the cash flow statement. As well as investments in securities and sale of securities. For example, if you buy shares, that's an investing activity. So when you buy shares in the share market, that will be recorded as a cash outflow. If you sell shares, if you sell securities, then you are getting cash by selling the shares. Then that will be recorded as a cash inflow, right? Now, these transactions does not get recorded in your income statement. Okay, so cash flow from investing activities looks at the amount of cash generated or spent on investment activities, right? Now, the dividend income you receive from your investments will be considered as a cash inflow here because you receive the dividend income as a result of the investment you have made, right? So all dividends received will be considered under cash flow from investing activities. Then the third and the final way you can do it is cash flow from financing activities, right? It shows the net cash flow that are used to fund the company, right? How have you funded the company? So this would include financing activities, include transactions involving debt, equity, and dividends. If you take a bank loan, you're going to receive cash. If you settle a bank loan, you're going to pay cash. So when you get a bank loan, it's a cash receipt. When you settle a bank loan, it's a cash outflow. If you issue new shares to the market, it's a cash inflow. If you repurchase shares from the market, it's a cash outflow. And since this is financing activities, for your debt and equity, you need to, especially for your equity, you'll have to pay dividends. So whatever the dividends that you pay will be recorded as a cash outflow under the cash flow from financing activities. So if I just summarize the cash flow statement, there are three main areas. Cash flow from operating activities, where you look at how much cash is being generated through your core business activities. Secondly, cash flow from investing activities, how much of cash is being generated or spent on your investment activities. Thirdly, the cash flow from financing activities shows the net cash flow that is being used to fund your company. So that can be in the form of debt, equity. Okay. So this is a typical cash flow statement. I have basically cut it short. Here you don't see the changes in working capital. So you start with cash flow from operating activities. This is the amount of cash this company have generated through their core operations. So compared to the previous year, the company have generated more cash this year from their core operation. Last year they generated 2.2 billion. This year they have generated 4.1 billion cash from their main business operation, core business operation. Then comes certain adjustments. As I said, the income tax, interest received, right? Those need to be adjusted here. So this is the net cash flow from operating activities. Second one is cash flow from investing activities, right? So what had come? Purchase of construction property, plant and equipment. So as I said, if you invest in your plant and machinery, it will be recorded as a cash outflow. So last year they have invested 268 million. This year they have invested more in plant and machinery, right? So I'm not going to go line by line. So in summary, by investing activities, last year they have spent 292 million on investments. This year they have spent 999 million. So this shows you from where did the cash come and where did the cash go, right? So from their co-operations, they generated 3.3 billion, and 292 million is been spent on investments this year compared to 999 million in the previous year. Third section is cash flow from financing activities. So as you can see, short-term borrowings, net of payments. So they have borrowed as well as they have paid their loan installments, right? So they have paid more loans than what they have borrowed. So the net amount is 1.8 billion. They have paid dividends of 179 million. So compared to last year, it's the same dividend that they have paid. So all in all, from their financing activities, they have there's a net cash outflow of 2 billion, right? So that means they have paid more loans this time compared to the previous year. And last year they have borrowed more. They have borrowed 896 million. Here this year they have borrowed only 32 million. So they have borrowed less and they have paid most of their debt. So they are reducing their debt levels. So they made 3.3 billion from their operations. They spent 292 million on their investments, and they have spent 2 billion on their financing activities by settling their loans. So this is the inflow, this is the outflow, and this is the outflow. Let me so this is an inflow of 3.3 billion. Here it's an outflow on investments, and here it is an outflow on financing activities. So when you net them off, the company have generated approximately 1 billion of cash this year. So this company is generating cash of 1 billion this year, compared to a net cash outflow of 445 million last year. So last year, their cash outflow have been more than the cash inflow. In the current year, cash inflow is more than the cash outflow. So they have a strong cash balance. So this is what they generated during the year. And here at the next line, you have what they already had at the beginning of the year. So they had 1.3 billion at the beginning of the year. They generated 1 billion during the year. So at the end of the year, they have 2.3 billion in cash compared to 1.4 billion last year. So this shows you the liquidity position of the organization. So they are liquid, they have cash. So they can go for new investments, they can pay high dividends, right? All are possible. So that's about the cash flow statement. Okay, right. So simply see whether the cooperation is generating cash and whether that is increasing. So in this company, their cooperation is generating cash, and the cash amount they have generated have grown compared to the previous year. And also look at the net cash and cash equivalents at the end of the year, whether it is increasing or whether it's a negative position. Okay, so let me now call upon Mr. Saliya to discuss about the technical aspects of investments. Saliya, over to you.
Right. Thanks a lot, Charitha. I'm Saliya. Thank you very much for joining us for this session once again, rather the third session. And we will be continuing to touch on the three trends that we are talking about. Basically, what we are trying to do here is to analyze and understand how the trends are being used by us as technical when we are using the charts and the price behavior, so that we will be able to determine as to the best opportunities that we will get in order to initiate our buying and selling decisions. Now, moving further on into the price action, we were talking about support and resistance levels, and today we will be talking a little bit further about waves within the price actions or within the fluctuations, Then we will be looking at how to identify the swing high and the swing low. Thereafter, we will be using the swing highs, the swing lows, and the waves to understand how we will be using the horizontal support and resistance areas. So remember, from the start itself, we were talking about the support and resistance areas, and that is very important. The reason as to why it is important is because the prices are moving in waves, just like we call them. I mean, we normally, in general terms, we call the prices are fluctuating, or we can say the prices are going up and down. But in the case of when we are learning the basics of technical analysis, you will find out that we look at a chart in waves, right? Those waves are the ones which are called the two trends, the up and the downtrend, and the sideway movement. Within an uptrend, a downtrend, and a sideway movement, you will see these waves, I would say, moving to and fro within those trends, the uptrend, and the downtrend, and the sideway movement. Now, in a wave, we first of all need to understand, or we have to identify the two starting points. In a wave, you have two starting points. If it is an uptrend, the starting point is the lowest level. The ending point will be the highest level. Conversely, in a downtrend, you will see the starting point as the high and the ending point is the low. Other factor that we have to understand is that every wave will be varying in sizes, in ranges, at the same time in time frames as well. Meaning, since we are now looking at a daily chart, which hence the period is, excuse me, hence the period is a day. Even within this day periods, you will see the waves will vary from a shorter time period to a fairly longer time period. Now, I'm using Valuable One chart today, and I will be using the present data that is shown in the video, in the screen rather, right now. And you can see that the period is starting from somewhere around September to date, as of today. But in that, I will be using only the retracement that we saw happening from January. Now, most probably you all are aware that a retracement is when the prices are falling. Now, talking of the waves, right? We will be describing at length about the retracements and why we call them retracements, the corrections, bear markets, and so on at a future session. Now, when it comes to these waves, when we are saying the uptrend and a downtrend, we have to remember that at any given moment, when these fluctuations of these waves are happening, they are either pullbacks or rallies, right? A pullback and a rally are of short in nature compared to the retracements or corrections, which we analyze based on certain classified percentages, right? So in a retracement, we will see many waves of pullbacks and rallies. So it is very important for us to understand how the pullback is happening and how a rally is taking place, because the more you get trained to analyze the charts and put that into use, you will understand that whenever there is a pullback, the opposite is a rally, you will be expecting that rally to take place. If it is a rally, then you will be expecting the pullback to take place. You know, that is the most easiest expectation when it comes to projecting what is to come, right? So as a result of that, we need to understand what is a wave and how to look at a wave. Now, as I mentioned, wave has 2 points, right? Generally, if you take from this low to this high, you might say that it's an uptrend, right? You might figure out, and it is clearly visible that that it is a clear, strong up movement up to here. But at this, thereafter, we have to understand, I mean, by easy visualization, just with our naked eyes, we understand that this is a significant move. We can easily see a low and a high. At the same time, there is a clearly visible high to a low here. This doesn't need too much of explanations or too much of kind of, you know, an analysis or time taken in order to identify this. But the thing is, within these major waves, you see ups and downs. So you basically have to break down these waves, or rather break down these moves into waves, right? So you have a starting point. Now the biggest move which is visible has a starting point here. Over here, there's a starting point. From here, you can, if you carefully analyze, you have an ending point here. Then again, a starting point there, and ending here. Then again, an end is here, or rather the starting point there, and that ends here. Again, starts at the bottom, and it goes up to this level. So we need to understand, just because we buy a stock, or, you know, just because the prices are moving, doesn't mean that the prices are going up in a one straight line. Okay, similarly, when it is coming down, also the same story. Now, when we understand that there are pullbacks and rallies, right, we know, okay, the prices are going up, right? But you will see prices coming down to the opposite, rather moving to the opposite direction due to the wave behavior, right? So wave behavior will help you to understand what types of strategies that you will be able to use in these waves. So most probably you might have heard about the meaning of the pullback and the rally. A pullback is when the prices are reversing to the bottom, to the downside. A rally is the opposite direction, when the prices are moving to the upside, right? So when the prices are moving up, it is called a rally. Then of course here there is a sideways movement. Then again a rally, a pullback, 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 and it goes on like that. Even over here, you might see that there are small ups and downs, right? So basically we have to understand that these are ranges. Just because these are plotted in candles, right, you have to, you know, take into consideration these ranges of the starting point and the ending point of the either the upside or the downside. Now, in a the reason as to why we do that is to understand. I mean, when the distance of the range kind of becomes shorter and it repeats in shorter ranges, then we understand that there is something happening, and which we will be talking most probably in the other, the future sessions as well. Now, the starting and the ending points of these waves are easily identified by a thing what we call a swing low and a swing high, right? Now, the swing low and the swing high is nothing difficult to identify. In a swing low, or first, let's say, since we are taking this extension over here, first the swing low, then the swing high takes place. What happens is, before a rally takes place, I mentioned there is going to be a pullback. In that pullback, what happens is, remember that the description that I made regarding the support and the resistance, right? Now, last week we showed you how to figure out the support line and the resistance line within a trend. But even in these waves, when there is a pullback is a downtrend, right? So what it means is that it is a support which occurs when a downtrend pauses, right? The pullback pauses at a certain level where a concentration of supply or buying interest takes over that area and making it a pause, right? And you also call them troughs and peaks because you have in these waves a V-shaped reversal, right? It is always in a wave, it's going to be a V-shaped reversal, right? If you look at over here, right? If you enlarge it, you will see a V-shaped reversal there. If you look at here, this pause has a V-shaped pause, right? So, I mean, if you just kind of break these waves down and look at these levels as I'm explaining to you, whether it is really happening. Now, it is very easy to look at those V-shaped forms or V-shaped reversals by looking at the most easily recognizable candles, right? I'm going to take one of those recognizable candles and explain to you what a swing low and a swing high is all about, right? In a swing high, the first candle, there are 3 candles for a swing high identification, right? The first candle of the swing high is where the candle, the first candle has a high which is lower than the second candle. Now, this is the first candle, the high is here, second candle's high is here, and the second candle's high is higher than the third candle. So you have a high, a higher high, and a lower high, forming a swing low, swing high formation. A high, higher high, lower high, making a swing high, right? So let's just highlight that for the time being over here. Then I'm just showing you all the easily recognizable areas. Now, the reason as to why this is easily recognizable is because there is a longer wick at the top, right? Compared to the wick, the clean head, we call it this a clean head because there is no, or rather a shaven head because there is no wick here, right? So, but still the top of the body, which is which is a bullish candle where the color is green, right? Uh, Tells us that this top of the body is the high and the close as well. So we take this high and the high over here, and there is a wick in this candle, the high of that as well. And as a result of that, the middle candle, the second candle, gives you a swing high formation. Conversely, the opposite direction, if you look at the low of this candle, which is the 2nd of February candle, you will see that the low there is 59.15. 59.15 is the low. Then the next candle that we can see here, we will be describing, there are many names for each and every candle. So we will be talking about that as well. Those are very, very important basics. So this is the 3rd of February candle, and that candle has a low of 58.29, right? So 58, 59, 59.15, 58.29. And the next candle, the low is 65.83. In a swing low formation, the first candle, the low of the first candle is low. The low of the second candle is the lowest low. First candle is low. The second candle is the lowest low. And the third candle is a higher low. Third candle is a higher low, right? Here, high, highest high, lowest high, or lower high, right? Here, the low, lowest low, higher low. Here it's lower high, here it's higher low, right? These, as time goes on, if you are really serious about, using the charts for your analysis, which is very important way forward, you will automatically remember these formations. So what you can do is just spot these. Right now, here you have a low here, lowest low, higher low, swing low formation. You have a high here, highest high here, lower high here, swing high formation. Again, the same formation of a swing low here, right? Let's take here, right? And then you have another low here, lowest low, higher low. So you can just keep drawing them and practice to recognize these areas. Now, the reason as to why, since we are in these basic sessions, I'm taking the time and trouble to show you all how to draw these lines and how to figure out the swing highs, the swing lows, and understand the wave behavior, is because you have to train your eyes, right? As time goes on, you will not be using these in your final analysis, right? You're drawing the chart, not because it's a piece of art, it's because it will help you to understand where to buy and where to sell and where to cut loss, where to stop loss, right? That is the reason we are looking at all these things. Now, once we figure out the higher swing highs and the swing lows, it will be useful for us to figure out the support and resistance areas, right? Now, since I'm taking the valuable one as an example, we have to remember one thing, that we are in valuable one, we are in all-time high price ranges, right? Even starting from around the 30s and upwards, we have moved into all-time high. We have moved into an all-time high price territory or price range, right? That we have to remember. As a result of that, I will tell you as to why understanding that we are in the all-time high is important, right? Understanding it is very important. So first of all, as I mentioned, I'm going to draw the horizontal lines, right? Remember, whether it's a horizontal line or a diagonal line, the best case scenario, right? Ideally, you need to connect 2 points. If you can see 2 points in the horizontal line drawing, it will be very important. But nevertheless, we will be plotting these swing highs and the swing lows and figure out what are the important, strong support and resistance lines are, right? So I'm using this swing high. Then again, I'll be using this swing high, first of all, let's look at the swing highs, this swing high. Give me a moment. That swing high. Let's change the color also, then it will be visible a little bit more. Right. Then we can see there's another swing high here. Then we can see there's another swing high here. Then onto the lower side. Swing low here. There's a swing low here. There's a swing low here. And finally, this is a significant low, even though you don't see the wicks at the bottom. You can see that it's a significant low. So we are taking that as well. Now, remember, just because I took these lines, it doesn't mean that these are the only lines given here, right? For the purpose of showing you how to draw them, I'm giving you these lines. Now, by using these lines, what are we going to do, right? Now, when I drew this line, right, this line, I dropped that line right on top of the wick of this candle. But if you go forward and see, exactly or almost at that level, the prices have tested that line. In other words, the prices have tested this high of 58.10, right? So then what it means is that's why I said these are not drawings that we are doing. These are, it gives you a message that 58.10 had become a resistance area. Now, what is a resistance? I mentioned that when a trend is moving up in an uptrend, when there is a pause due to the concentration of suppliers and the selling interest. So this 58.10 area has become a resistance where the supply, concentration of supply is high and the selling interest is also high. Right now we are in the present period. Okay, in the present period, 58 has become a resistance area. So we need to understand when we are wanting to make a decision whether we want to buy this this stock, right, at the present price of maybe 53.80, we will have to expect that 58 area of resistance, right? So that is the reason as to why we took that. Now, this I purposely drew by taking this what do you call this significant area. But if you look at the other line, I took this, right? I took this and I took this level to draw these two lines, right? If you look at the previous price behavior below these two lines, you can see that it has come up to this level. You know, at this point, there hadn't been any response, but it went up and tested this area. And then when it retraced, it came to this level, which we are using right now. Okay. So now what that means is that we are watching that area, right? The area between a low of 50.60 to a low of 52 rupees, right? We are wanting to, we are like, we drive these two lines to understand, right, for our analysis, whether the prices are going to come down to that level, right? Because these two we have taken from the price behavior of this period and this period. We didn't use any of the previous levels, right? And over here also we took this as the level. Therefore, we cannot, you know, we cannot say that this area was paused and changed because of this line. The message I'm giving you is this: just because we draw lines doesn't mean that the prices are going to go there, right? And because there's a line, it comes down. That's not the idea of looking at the lines, right? You know, from the start, remember that. From the start, we need to understand that just because there's a line doesn't mean that the prices are going to come down. Some people get scared when we draw lines like this, right? They think because of the line, it's going to come down. No, these lines are being used as guidance for us, right? To understand the support area and the resistance area, right? Now, so far in Sri Lanka, we have a one-side market, meaning you have to buy to sell, right? Therefore, the support areas, our areas are our friend, meaning there is a thing called a trend is your friend, right? So our trend is buying trend, right? Meaning buying at the best possible lowest price to sell at the best possible highest price. Therefore, we have to remember that the reason as to why we use these lines, right, is to give us a guidance where the support and the resistance levels are going to be tested, right? Always those levels are going to be tested. But these testing areas invariably becomes areas for us to be buyers and sellers, right? In a resistance, I told the prices are moving up, pauses due to a concentration of sellers, right? So in that concentration of sellers, if we are interested in selling at that price, we are also part of that concentration. Downward pause is a support due to a concentration of buyers, right? So at that point, if you're interested in buying, we are part of that concentration. That's why I firmly believe that understanding the price action in the best sense, right, in the most practical, realistic way, you can make use of the price action for your benefit, right? With that, I'll be ending. hoping to meet you once again next Wednesday. Have a good evening. Thank you.
Thank you, Saliya. Right. Thank you everyone for joining today. And I hope that you all got some good insights into fundamental and technical analysis. And I also recommend if someone joined today, just go and see the first 2 videos so you can get the basics. And now the floor is open for any Q&A.